Hello, everyone. This is Brian Bortz. I am one of the partners here at Kane Waters and also the chairman of our investment committee. And I am joined today by Brad Sanders, who is with Tectonic Advisors. Unfortunately, my partner Hunter is not able to join us today, so you guys are just stuck with me today. And this is our April investment market update. As you can see, the month of April was pretty rocky, pretty rough. A lot of news that came out that inflation was being tricky and sticky and really wasn't going anywhere anytime soon, wasn't falling as quickly as the Fed hoped. You can see that the S&P 500 or stocks for the month of April were down 4.1%, which is a dramatic move for 1 month, given the fact that it has given back probably almost 80% of what the gain was for the first quarter. Global stocks were down 3.3%. Domestic bonds were down 2.5%, as were global bonds. And really, what I wanted to do today was just let Brad tell you a little bit about what we see happening, what's driving the markets and the economy, and then add a little bit of flavor on some things that I've been talking to my clients about. So with that, Brad, can you tell us a little bit about what in the world is going on and why did we give back so much of our gain from the first quarter in the last 30 days?
Yeah, it really started early to mid-April. We got a hot PCE number, and that's a inflation reading that the Fed pays particular attention to, and it was hotter than expected. And the market really started to peel back after that, because when you got that number and you saw what the components of that they're going into it, it became readily apparent to the entire market that we're not getting rate cuts anytime in the near future. And the market had priced in 6 to 7 this year. So the market unwound the 2 to 3 that they had already priced going into May very quickly. And then I thought, yesterday was interesting. It's Thursday, and we had the Fed meeting yesterday, and they came out and they didn't raise rates, which is no shock to anybody. But they still issued kind of like an incrementally dovish statement where they said, "Yeah, we're not talking about raising rates." There was a lot of trepidation going into that meeting that they could say, "Hey, we may need to raise again." And they said, "We're not doing that." And we're going to slow down our pace of quantitative tightening from 60 billion a month to 25 billion a month. But we're going to be higher for longer still. And it was really interesting. The market rallied like 2% in about an hour. And then by the time the market closed, it had come all the way back to where it was pre-meeting. So I think what we're having right now is just kind of a cold bucket of water dumped on everybody's soft landing hopes. I don't think we're going to be able to get one engineered, because in order to do that, the Fed would need inflation cooling, and we would need to be cutting rates now. And so I think the market's going to, I think we've said this on these videos, and I know I've mentioned it in our letters several times. We kind of expected this year to be like 2023, where you ended up in a great spot, but in the interim, it was really volatile, and it was kind of a roller coaster to get there. And that looks like what we're going to do again this year. We're going to have to go through the summer without getting any of those rate cuts. In our estimation at Tectonic, I guess my opinion, I'll give it. I don't think we're going to get rate cuts at all this year. I think there's a glimmer out there. We could get maybe one in December post-election. But I think what investors need to start realizing and our clients need to start realizing is if the Fed were to come and cut rates now, the market would probably go down. Because with the economic data and inflation data where it's at, if they were to cut rates like this summer, it means something very bad has happened, right? You can't ease policy with a sticky inflation number at 3.5 when your target's 2. You can't ease in those conditions, or we're going to get a secondary wave of inflation. And so if they were to ease, it means there's something bad out there that's going to wash out all this inflation, and they're needing to ease policy to get out in front of it. So I don't think we want rate cuts, frankly. I just think we need the market to price itself accordingly. The market's been kind of rocking along, just going, "Oh, we're going to get these rate cuts so we can just go ahead and drag all that growth forward." Well, now, we're going to be, by the end of this year, we'll be 18 months away from when they thought we should start getting policy eased, and we haven't had any. And higher for longer is just going to be a headwind to growth, but the market can adjust to it. And I think, um, having a long-term real interest rates is better and healthier for our investment portfolios anyway. So I just think we're going to have to go through this adjustment period. Parts of the market are going to act poorly. You've seen big directional moves from the Magnificent Seven, like they have earnings and one's down 15%, the other one's up 15. That's probably a segment of the market that's trying to get its sea legs because it knows that it's mispriced based on where real interest rates are going to be going forward. And so I just think the next couple months are going to be super bumpy like that. But it's going to be for the better. And I think no matter what the result, when we get through the election in November, that's going to kind of act as a release valve. Get all that uncertainty out of the way. We know who both these guys are, so it doesn't matter what side of the aisle you're on. The market knows what's going to happen if Trump wins or Biden wins. So you just take the uncertainty off the table, and I think we can move forward from there and maybe finish the year strong.
That's great. I appreciate that, Brad. Hey, I have a couple of follow-up questions though from some of the comments that you had made. So you said that you believe that there probably may not be any rate decreases, and if there is, it may be towards the end of the year. If that happens, I agree kind of with what one of your comments was, that we may look a lot like 2023. Most of the gains, if you remember, in 2023 were really the last 2 months of the year. Yeah. So that may actually happen again. But you also mentioned that you were not sure that there's any possibility of a soft landing. So what does that mean for our clients if we really can't get to a point to where we're avoiding a negative outcome? What does that look like?
It's just probably going to look and feel like something like a mild recession, whether or not you get and why I say that, I guess I should clarify, is you're starting to see things slow down a little bit. GDP's down into the 1% range. It's still positive, but it's much lower than they expected. If you start picking through the consumer data, the consumer writ large, probably not our clients. Our clients are top 1%ers for the most part. But the average American consumer is probably struggling right now. If you look at credit card debt levels and discretionary income, depending on where you are in the country, there's lots of reports like, hey, these restaurants normally packed and like you can just walk in and sit down. Now you're starting to just see like the consumer's tired. And so it's probably going to look and feel like a little bit of a mild recession because the longer these rates stay higher, the tighter monetary conditions are, and it's just going to continue to squeeze that consumer. And 72% of our GDP is consumer spending. And so I think the soft landing, to engineer that, they really needed those inflation numbers to come down dramatically so they could cut rates like somewhere like now, where it's like the consumer's starting to get tired. We got this inflation number down, we can cut, and that's going to act as relief and reliquify the system. And it just doesn't look like we're going to get that. So do I think we're going to have like a horrific recession or something like that? No, I don't. The dollar's really strong. And we have a lot of areas of the market that look good. A big chunk of the market's not terribly expensive because it repriced in 2022 and hasn't really rebounded. If you remember, last year was a bunch of tech stocks. So we're not in a spot where everything's expensive, everything needs to reset, but we are in a part where the market's top heavy, the consumer's tired, and you may just get some sort of reallocation of capital throughout the market. And maybe a couple quarters of real sluggishness and then come out of it that way. But I don't think that soft landing that dream scenario, it's not off the table, but in my estimation, we're not counting on it.
That makes a lot of sense, man. I appreciate you adding some more flavor around that. The message that I've been telling to our clients is that, the Fed told us long ago, higher for longer, and they have stayed higher for longer. And they're really looking for economic data points before they make a decision to make a change. And, keep reminding everyone that the economy is different than the stock market. And, the stock market's going to do what it wants to do to some extent, but it does have to answer to the economy ultimately. And so at some point, I agree, Brad, and this is what I've told my clients, is that the world's not dark. We still have a growing economy. And it's just going to take a while, and just to be patient. And there's really no need to make any dramatic changes to their portfolios. So with that, I thank everyone for listening and look forward to catching you guys next month. Hopefully Hunter can join us and we'll see you then.